The source cuts off mid-sentence at the end, so this paraphrase covers the portion that was shown. On March 9, 2009, the S&P 500 closed at 676. The financial system was collapsing. Lehman Brothers had already failed 6 months earlier, retirement portfolios had been slashed in half, and the headlines were calling it the worst economic crisis since the Great Depression. Most Americans were scared out of their minds. A school teacher named Margaret did something that, at the time, looked completely irrational. She took the $50,000 she had been saving for a house down payment and put it into an S&P 500 index fund. Her friends thought she had lost it. Her family begged her to wait until things calmed down. Margaret ignored all of them. Today, that $50,000 is worth about $590,000. She did not pick the perfect stock. She did not time the market. She did not have inside information. She simply recognized one of those rare moments that only shows up once or twice in a generation, when fear creates an opening that can change an ordinary person's financial future forever. Most people do not realize that we may be standing in a similar moment right now. Not a crash exactly, but something possibly even bigger. A rare combination of forces that has not appeared in almost a century. Forces that could shift more wealth to everyday people than any event in American history. The number is $124 trillion. That is not exaggerated. $124 trillion is moving over the next 2 decades, and most people have no idea it is happening or how to position themselves to benefit from it. Today, I want to show you what is really unfolding. Why this moment looks a lot like earlier wealth-creating periods that produced millions of new millionaires, and what regular people are doing right now to make sure they are on the receiving end of that historic transfer. What happened after March 2009 is the perfect example of how ordinary people build extraordinary wealth. The S&P 500 did not just recover from that low. It went on to become the longest bull market in American history. From March 2009 through January 2026, the market climbed more than 900%. The index recently crossed 7,000 points for the first time. That means $100 invested at the bottom grew into roughly $1,000. But the biggest winners were not hedge fund managers or Wall Street insiders. They were teachers, nurses, accountants, and small business owners who kept contributing to their 401(k)s and IRAs while everyone else panicked. The numbers tell an incredible story. In 2010, the United States had around 8.4 million millionaire households. By the end of 2024, that number had almost tripled to nearly 24 million. More than 15 million new millionaire households were added in just 14 years. Think about that. 15 million households crossed the $1 million line in less than a decade and a half. That is roughly the entire New York metro area becoming millionaires. Most of those people were not founders selling companies or executives cashing stock options. They were everyday investors riding the market through retirement accounts and index funds. UBS's 2025 Global Wealth Report says the U.S. added 379,000 new millionaires in 2024 alone, which works out to more than 1,000 new millionaires every day. Most of them did not get rich from some giant windfall. They got there through steady investing in rising markets. UBS calls this group everyday millionaires, people with between $1 million and $5 million in net worth. Globally, that group has quadrupled since 2000 to about 52 million people, and they now control more than $107 trillion in wealth. There is nothing secret about the path to joining them. It is documented, it is repeatable, and it is getting easier to access. What makes today even more important than 2009 is the Great Wealth Transfer. Sara Lee Associates' latest research from 2025 estimates that about $124 trillion in assets will change hands between now and 2048. That is the biggest transfer of wealth in human history. Nothing in economic history comes close. To put it in perspective, $124 trillion is more than the combined annual output of every country on Earth. It is more than 5 times the current U.S. national debt. It is wealth built over 8 decades of American growth, and now it is about to flow through the generations. The mechanics are simple, but the consequences are huge. Baby boomers, born between 1946 and 1964, currently hold about 52% of all U.S. wealth, which is roughly $78 trillion concentrated in one generation. The youngest boomers are now 62. The oldest are nearing 80. Over the next 20 years, that wealth will move to children, grandchildren, and charities. Sara Lee estimates roughly $106 trillion will go to heirs, with another $18 trillion going to charitable organizations. Generation X is expected to inherit about $39 trillion over the next 25 years. Millennials are projected to receive about $46 trillion. Even Gen Z will start seeing meaningful inheritances as the transfer speeds up through the 2030s and 2040s. The timing matters a lot. Gen X, the generation people often forget about, is expected to receive around $1.4 trillion a year over the next decade. That comes at a very important life stage when many are supporting both aging parents and their own children. For them, this inheritance wave could change retirement outcomes that currently look shaky. Millennials have a longer wait, but their eventual windfall is larger. The $46 trillion headed their way will arrive while many are in their highest earning years, which creates a powerful compounding effect when inherited capital grows alongside career income. But the biggest thing most coverage misses is this: the opportunity is not only about inheritance itself, it is about the ripple effects created when that much wealth starts moving across the economy. When $124 trillion changes hands, it does not just sit there. It gets invested, spent, redirected into businesses, real estate, and markets. Every dollar that moves creates openings for people who are ready to catch it. The last time anything even remotely similar happened was after World War II, when returning soldiers used the GI Bill to buy homes, launch businesses, and build the middle class that powered American prosperity for decades. That wave created the baby boomers, who are now passing their wealth forward. What we are watching now is history repeating itself, but on a scale much larger than anything before it. The parallels with 2009 go deeper than most people realize. Back then, 3 conditions lined up to create huge wealth for people who recognized the moment. Assets were deeply undervalued after stocks had fallen 57% from their peak. Massive capital was about to enter the system through stimulus and quantitative easing. And most people were either too afraid or too financially stretched to take advantage. The current moment is different in mechanics, but similar in opportunity. Markets are not in a crash, but the wealth transfer will create both dislocations and opportunities. Some assets will be sold to settle estates. Others will be passed to heirs who prefer different investments. That movement will create buying opportunities for people who are ready throughout the whole transfer period. This time, the capital wave is not coming from the government. It is coming from the richest generation in history, handing down assets to the next one. The scale is enormous. $124 trillion is 25 times the size of the pandemic relief effort, which totaled around $5 trillion. And just like in 2009, most people are barely paying attention. The great wealth transfer gets a tiny fraction of the attention given to daily market noise, even though it will matter far more over the next 20 years. The people who became millionaires after 2009 were not smarter than everyone else. They were simply in position when opportunity showed up. That same principle applies now. But to capture it, you need to understand a few important dynamics. First, inheritances alone will not create most new millionaires. That sounds surprising given the headline numbers, but the math makes it clear. Sara Lee estimates that about 62% of all transferred wealth will come from high net worth and ultra high net worth households, which are only around 2% of all households. The transfer is highly concentrated. A small number of families will inherit massive fortunes. Most households will receive more modest sums or nothing at all. So relying on inheritance as a wealth strategy is a mistake. The real opportunity is not the inheritance itself. It is the effect that moving all that money has on asset prices, business activity, and the broader economy. When trillions flow into investment accounts, asset prices rise and benefit people already invested. When heirs buy homes, real estate values go up for existing owners. When inherited capital funds new companies, job creation rises and workers benefit. The wealth transfer creates rising tides across multiple asset classes at the same time. Second, understanding where that money will go matters a lot. Research from Bank of America and Merrill Lynch shows that younger investors think very differently from baby boomers. Their studies found that 72% of investors between ages 21 and 43 no longer believe above-average returns can be achieved using traditional stocks and bonds alone. That is a generational shift in investing philosophy that will move trillions of dollars. Boomers favored blue-chip stocks and bonds. Their heirs lean more toward alternatives, direct investments, and newer asset classes. Sectors favored by younger investors are likely to absorb a massive share of capital over the coming decades. AI infrastructure is already seeing huge investment in 2026, with NVIDIA helping drive market returns. Clean energy, healthcare innovation, and digital assets are also positioned to capture major flows. That does not mean abandoning traditional assets. It means understanding that capital is changing direction and positioning yourself accordingly. The sectors that boomer money supported may lag relative to the sectors that younger capital favors. Third, real estate positioning will matter a lot during the transfer period. The Great Wealth Transfer will reshape housing in different ways depending on location. Demand will rise as wealthier heirs look to buy homes. Supply will rise as inherited properties hit the market. Areas where boomers concentrated, especially suburbs and retirement destinations, may see more inventory, which could temper price growth. Places where younger people want to live may see even more competition as newly wealthy millennials enter the market. The data already points to this divide. Median home prices have risen more than 150% since 2000, but those gains have been very uneven. Markets attracting younger workers and technology investment have far outpaced shrinking cities. The same $500,000 in Austin versus Cleveland can lead to dramatically different results over the next 20 years. Geography matters, and it matters directly for wealth. Fourth, staying invested through the whole transfer period is still the most reliable strategy. Remember Margaret, the school teacher who put $50,000 into the market at the bottom in 2009? She did not need some fancy strategy. She needed money to invest and the discipline to leave it there through the volatility that followed. Over long stretches, the market has returned about 10% a year on average. Someone who put $500 a month into an S&P 500 index fund, starting in 2009, would have over $250,000 by early 2026, not including any employer match. But getting there was not easy. There was the European debt crisis in 2011, the government shutdown in 2013, the trade war in 2018, the pandemic crash in 2020, and the 2022 bear market. Each time, headlines said the rally was over. Each time, people who stayed invested captured the recovery. The Great Wealth Transfer will create similar opportunities, but the most reliable way to build wealth remains the same: consistent investing in broadly diversified assets over decades. The transfer just gives that strategy extra wind at its back. One thing people often forget about these big wealth-building events is how they feel while they are happening. The post-2009 period did not feel like a golden age in real time. The headlines were always full of reasons to panic. Every crisis seemed to predict the end of the rally. And yet the market kept climbing. The S&P 500 passed 2,000 in 2014, 3,000 in 2019, 4,000 in 2021, 5,000 in early 2024, 6,000 in late 2024, and 7,000 in January 2026. The people who stayed invested through the anxiety built wealth. The people who kept running to safety kept missing the upside. Goldman Sachs research shows that missing just the 10 best days in the market since 2009 reduced annual returns from about 17% to about 12%. Missing the 25 best days cut the return almost in half. And the best days usually show up during the most volatile periods, when fear is highest. The same pattern will likely show up during the Great Wealth Transfer. Recessions, corrections, and crises will happen along the way. Headlines will keep saying, "This time is different," History says those warnings will probably be early, just like they were after 2009. The underlying force, $124 trillion needing productive homes, will keep creating opportunity no matter how noisy the short term gets. The math for consistent participation makes this very clear. Picture a 35-year-old today investing $500 a month in a diversified index fund for the next 25 years, which is roughly the length of the Great Wealth Transfer. At a historical 10% annual return, those $150,000 in contributions grow to about $665,000. At a more cautious 7%, they grow to about $405,000. If the capital flowing through the economy lifts growth by even 1 percentage point, the long-term result changes a lot. That 7% becomes 8%, and the $405,000 becomes roughly $475,000. If the monthly contribution rises to $1,000, which many people can do as their careers progress, the numbers scale dramatically. At 10%, that becomes $1.33 million. Regular people can become millionaires through consistency alone. The numbers may look abstract, but they are the difference between a comfortable retirement and a life of financial stress. The wealth transfer will make those outcomes more achievable for more people. The professions and businesses that support all this wealth movement will also benefit. When $124 trillion changes hands, whole industries expand to handle the process. Financial planning, estate administration, tax advisory, wealth management, and legal services are all going to grow. Real estate transactions will accelerate. Trust and estate disputes will increase. People who develop skills in these areas will find strong demand throughout the transfer period. The wealth movement does not only benefit heirs, it also benefits the people who help manage, protect, and deploy that wealth. The numbers already show the shift. At firms focused on high net worth clients, the share of Millennial and Gen Z clients rose from just 8% in 2021 to 25% by 2024. Advisors who understand younger clients are capturing business that will compound for decades. There is also a major spousal transfer opportunity before the intergenerational transfer even happens. Sara Lee estimates that about $54 trillion will first pass to surviving spouses before moving to the next generation, and nearly $40 trillion of that will go to widowed women. That creates a huge and growing market for financial services focused on women. Advisors, planners, and wealth managers who learn to serve that group well will capture major business as women become the primary controllers of unprecedented wealth. The entire transfer will unfold over decades, not all at once. This is a marathon, not a sprint. People who position themselves early will compound their advantage the whole way. The question of timing always comes up. People want the perfect moment, the exact bottom, the ideal entry point. The 2009 low looks obvious now, but nobody knew it was the bottom at the time. The market could have gone lower, and many people expected it to. The great wealth transfer does not have a bottom to wait for. It is already underway. The oldest baby boomers are 79 in 2026. Transfers are happening right now. Waiting for a better entry point just means giving up years of compounding while capital keeps moving. The best time to plant a tree was 20 years ago. The second best time is now. The same idea applies here. What stands out to me most about both the 2009 opportunity and the moment we are in now is how public the information is. There is no secret code. Grit code.